Currently, the yield to maturity of debt mutual funds have become very attractive, which makes it a very good time to enter these funds or to add to your allocation to them. Don't focus on the past returns of these funds. Instead, look at their yield to maturity to get an idea of the returns that you're likely to earn from them in the future. These were some of the views shared with us by Mr. Manish Banthia, Deputy CIO, Fixed Income, ICICI Prudential Mutual Fund. Mr. Banthia says he expects the RBI to hike the repo rate by 25 basis points more in February and then follow up with a long pause. Watch this interview to understand the trajectory of interest rates and the best categories of debt mutual funds to invest in right now. Good morning, Mr. Banthia, and welcome to our show.
Good morning.
This is we are approaching the end of the year, and a lot of retail investors will sit down with their investment advisors and they will review their portfolios. So I thought this would be a good time to talk about the year gone by in debt mutual funds and also have a discussion on the year that is going to come. My first question is, what in your view were some of the positives for retail investors in the year that has gone by?
So I would say that fixed income as an asset class, it behaves very cyclically. There are periods where you have interest rates which are being cut, and then there are periods where interest rates are being hiked. So to talk about the positive part of fixed income is last year or so. It was very difficult to make returns on the fixed income portfolios because the base YTM, the base interest rates were so low. I mean, the overnight rate was at 3.35. Your 1 year CDs used to trade at around 4%. So therefore, the portfolio yields were so low, it was very difficult to generate returns. I think from there, what has happened in this year is uh, as the RBI has increased interest rates, the overall portfolio has started to look very attractive in terms of YTMs across the portfolios of mutual fund industry. So from that perspective, I think fixed income as an asset class, which was I would say, a suboptimal asset allocation for the last 2 years, has become a very attractive asset class from an asset allocation perspective this year.
So this is a good time to actually enter debt funds, even though past returns at present are looking very poor for most categories.
Look, I would advise every investor that you should not look at past returns to understand, your prospective future trajectory of returns. The reason is that, as I said, fixed income is cyclical. So whenever interest rates move up, the impact on portfolio returns is negative. So therefore, the past returns would look negative. But the right way to look at prospective returns or prospective expectation is look at the current YTMs, and they are more meaningful to look at what effectively would be an approximate return over a 2 to 3 year period. So if you look at the last 1 year, RBI, as I said, has raised interest rates, and effectively, the last year the 1 year CD was at 4%. So if you had 1 year CD which was invested, say, at 4% in your portfolio, the last 1 year you could have made 1 year by just having that asset in your portfolio. It was very difficult to make anything more than that. But now, as the 1 year CD has gone up to 7.5 and more, I think that the incremental ability for the portfolios to generate return has substantially changed. So therefore, it is more meaningful to look at the YTM to understand where the market is and not concentrate on the past. I think that's a big fallacy which investors have in their mind, and which is where after the markets have already rallied, you will see that most of the money comes in, which is not the right way to invest. So I think that's a point which investors should keep in mind.
Where are inflation and interest rate headed in the coming year?
So As far as the Reserve Bank of India is concerned, I think they are moving to a point where they will pause interest rates very soon, maybe in the next policy or the policy after that. The overarching framework for Reserve Bank of India at this point of time, in my assessment, is that they are okay with inflation being at around 5.5-6%. I don't see this Reserve Bank of India targeting necessarily a 4% inflation. And therefore, as they get comfort that interest rates will slide below 6%, I think they would be okay to take a pause. And as far as the economy is concerned, I think the economy itself is has started an expansion cycle this year. We were in the early cycle in the last 1.5 years, where economy was slowly and gradually recovering out of the COVID. Now I think most of those fears are behind us, and therefore the economy is able to expand now. So in this expansion phase, I don't think there's excess demand right now in the economies for Reserve Bank of India to tighten too much. But given what is happening globally, and given that inflation has more or less remained, more than 6% on an average over 3 years, they any which ways had to hike. But I don't think that hiking or the interest rates would be excessive for the economy at this point in the cycle, which is where I see a pause by Reserve Bank of India at some point of time in the next one or two policies.
So, how many more rate hikes and of what quantum? And then, how long a pause do you expect? I know I'm
So my
kind
base,
of pinning
my
you
base
down,
case,
but
no, I understand it's a question which is in everybody's mind. My base case assumption is that RBI hikes by another 25 basis points and then kind of takes a pause. Now this pause can be a very long pause. I know as investors, we have only seen RBI either hiking rates or cutting rates in the last 4-5 years. You've not seen a phase where interest rates have remained at a particular level and stayed there for a long period of time. I think we need that stability of interest rates for the economy to expand, and which is the phase we are in. So, in my assessment, I think this pause can be a long pause by Reserve Bank of India, where there will be no hikes or no cuts after RBI pauses, and effectively, therefore. From a portfolio perspective as well, you have to build in a pause kind of a framework to invest. You can't build a hike or a cut right now, in your portfolio from that standpoint.
so could you elaborate on the pause point a little? What are the reasons for expecting a long pause? Because at some places, I've also read some analysts state that rate cuts could follow very soon. So why do you believe that there will be a long pause?
So, for that, one needs to understand the business cycle theory, and interest rates are very much aligned to the business cycle or economic cycles. So, you have a phase of economic cycle where, economy is slow, and in that phase, the necessary, action from Reserve Bank of India is to support the economy through interest rate cuts, through liquidity infusion. After that phase, we normally have a phase of economic recovery in which the economy slowly and steadily starts to recover. And towards the end of this phase, the Reserve Bank of India wants to move to a neutral rate of interest. And which is a phase which we are in right now, where Reserve Bank of India is moving to a neutral rate of interest. It's not a tight rate of interest. Even if you look at the stance of Reserve Bank of India, they're withdrawing accommodation right now. At some point of time, when they pause, they will say they'll have reached the neutral. Now, the economy, when it reaches neutral, the economy has a central tendency to continue to roll unless there are policy measures which, either increase the pace of that expansion or reduce the pace of the expansion. But in this phase where, where it's a mid-cycle, the private sector activity, they starts to expand. The normal phenomena is that credit growth picks up. The private sector investment demand, which was absent for a long period of time, that comes in. That provides some supply side to the economy because demand continues to improve. So you have a rollover in the economy where the economy continues to roll without generating excess demand and without having supply side issues. This is the most important phase of the economy. Once you are through this phase, there's an excess demand phase which comes in the economy, and because of that, you have either capital allocation problems or excess demand issues in terms of inflation, which you typically call the late cycle, which is where the US is at this point of time. In the late cycle, the central banks have a tendency to increase interest rates because they want to slow down the economy. And once they achieve that, once the economy starts to slow down, then there's again a rate cutting cycle. But the longest phase of any cycle can be the mid cycle, which is the expansion cycle. It all depends on what kinds of policy measures and what kind of environment is created for that mid cycle to continue. So it's very difficult to say how long the mid cycle can continue, but if the policies are right, it can continue for a longer period of time. So, for example, in case of India, if you look at the past, uh, in the 2003, 2009, 10 cycle, you would see that the mid cycle continued for 4, 5 years before we went into 2010, 11, when excess demand created inflation, high current account, all of that problems creeped in. We moved into a late cycle, and then RBI had to hike short-term interest rates to almost 10.5%, and then we had a slowdown phase, which also lasted a long time of period of time because there were balance sheet issues within the corporate and banking balance sheets. But the mid cycle, therefore, can be a very long period of time, and I think which is where we are approaching as an economy. So my base case assumption is that we'll have this long period of mid cycle, and any which ways, if you are targeting a 6% inflation, at 6.5%, you're not tight enough for letting the economy slow down. So therefore, I don't think from a monetary policy perspective, RBI will take the interest rates so tight that it leads to a slowdown at this point of.
So it's all linked to the state of the economy. My next question is, which segment of the yield curve is looking attractive and which debt fund categories correspond to those?
So as I said, this is a mid-cycle, and in mid-cycle, you would see a pause in interest rates. So effectively, the returns which will get created will largely be through the portfolio yields and not out of portfolio duration. So I don't think in this period duration will create excessive returns for portfolio returns. Most of the portfolio returns will get generated out of portfolio YTMs. So a short duration, high YTM strategy is the one which I think should be the most attractive strategy in this period of the economic cycle. Um, and any which ways, as I explained, after this part of economic cycle, there will be an excess demand cycle where RBI will increase interest rates again. That will be a tightening stance of RBI. When RBI goes to a tightening stance, that is the period you add duration to your portfolio. Right now, RBI is moving to a neutral stance, and I think the portfolio duration, which is short, but at the same time, optimized in terms of YTM, is the best strategy in my view.
So which debt funds exactly would you suggest for investors at this point?
So at this point of time, we're suggesting funds like all-season bond fund, credit risk fund, short-term bond fund, all of these funds, floating rate, fund, all of these funds have the ability to, have lower duration at the same time optimize YTM depending on different risk parameters. So from that perspective, I think all of these funds are suited in the current environment.
Now, a large number of retail investors are very eager to jump into longer duration funds. As you just said, that may not be very advisable. Could you spell out why they should not go into long duration funds and why that could be a risky strategy at this point of time, especially if
Right.
they don't have a long enough investment horizon?
Right. So, in my opinion, you get into long duration when one, the yields are on the long duration side are very attractive. And that normally happens when RBI is tightening interest rates, not when RBI is taking interest rates to neutral. And I don't think in the current framework, at 6 quarter, 6.5% of repo rate, RBI is tightening interest rates, given that they are okay with inflation being at 5.5, 6%. It was very different to look at the same level of interest rates when RBI was targeting 4%. I'll explain you how. So when RBI is targeting a 4% inflation and you're getting say a 7.5% on the 10 year, effectively you are getting a 3.5% of real return over the inflation target. I think that rhetoric from RBI has changed, and their thought process right now is that economy is okay at 5.5, 6% of inflation. Now, when economy is at 5.5, 6% inflation, and the 10 year is at around 7, 7.5, that is only an additional 150 basis points over the inflation target. So I don't think that's high enough to create attraction for investors to get into this part of the economic cycle. Secondly, if you look at the shape of the curve is very flat. So, which effectively means that if you buy a 1 year CD, right, you're going to get 760, 770 as a yield. If you're going into a 10-year corporate bond, the yield is the same. If you're going to get into a 10-year GSEC, the yield is lower. So effectively, there's no carry, which additional carry or additional remuneration which you get by taking an additional duration risk. So unless you are looking at interest rate cuts, or you are looking at a yield curve which is very steep, which effectively means that 10-year trades at a level which is very high compared to 1 year, I don't see a reason why long duration should make sense for investors at this point.
Now, ours is a young nation, and new investors are entering the debt mutual fund universe all the time. What would your advice to them be regarding fund selection and portfolio construction using debt funds?
I think debt funds, from a perspective of the way they are positioned, the whole plethora of product category which SEBI has created, I think the industry has created a secular structure for investors to get into the fixed income segment. And compared to the traditional investments, I think there are very many benefits of getting into the debt mutual fund. Now, as a mutual fund, our normally endeavor is to allow investors to have a good experience while they are investing. So our focus always is on products which can generate better experience rather than absolute returns in themselves. So therefore, even on the equity hybrid side, we have products like Balance Advantage Fund, where the idea is that you don't need to time the market, because the fund itself will increase and reduce the risk in terms of valuations. Even on the debt category, we have funds like All Seasons Bond Fund, which do exactly the same. They are based on our internal valuation models, and the idea is that investors, whether they enter today or they enter tomorrow, they do not have an experience which is very different. So effectively, we manage the risk of investors in such kind of products. And I think this approach is helpful because not all investors would understand the intricacies of the market, and therefore that experience for the investor is very important for us to concentrate on.
So the all seasons fund would basically belong to the dynamic bond fund category.
Yeah, it's the dynamic bond fund category, but it's got a very flexible strategy in terms of what it can do. It can invest in government securities. It can invest in SDA, SDLs, floating rate bonds, AAA corporate bonds, AA corporate bonds. It has the flexibility to move duration from 1 year to 10 year. It's got a lot of flexibility built in. The idea is that when you have a lot of flexibility, you should know how to control the risk. So the entire thought process of the fund is to have a process around how we manage this fund, and which makes this fund so very unique in terms of its proposition. We have an in-house model in terms of how we allocate portfolio for this fund, and which effectively helps us to move in terms of portfolio allocations at different points of time.
Do you have any advice for investors on selection of target maturity funds, which is the hot product currently? Like, should it be based merely on the investment horizon they have, or should they apply some other criteria as well?
So again, this is a category of fund which I think is a great offering from mutual fund space, given that the simplicity and the way investors can understand the product. In my assessment, I think, as I said, there's no reason for anybody to take a very long duration bet at this point of time. So I think, products which mature in 2025, 26, 27, which is, where investors can also remain for more than 3 years and get tax advantage, that I think is the most attractive point in my assessment at this juncture. For very long-term, deployment, I think there will be better times for investors to do that, which effectively means that if they want to deploy for 10 years, 20 years, 30 years, they possibly can get better entry points, in my opinion.
Now, these target maturity funds have different portfolios. You'll find some which invest only in GSECs, some which invest in a mix of GSEC, SDL, AAA, PSU bonds. Does that make a difference? Or are the risk levels very similar across these products and investors need not really bother about where these funds invest because they are all high quality bonds that they invest in? What is your view around this?
So I think one way to look at is that effectively, there's a spread which investors should look at. What is the spread between government of India, central government security versus a SDL versus a AAA corporate bond. I think these spreads move up and down given their demand supply in the market. And it is important, I think, to look at it from a return perspective. I think from a risk perspective, of course, Government of India is the safest asset class, and AAA bonds or SDLs follow Government of India risk. But all the three categories are categories where risk parameters are very tight, and therefore the expectation of risk is very low. Any which ways, these are index funds, so there's very little flexibility available, from a fund manager's perspective to create portfolios outside the index. So from that perspective, there's a very large transparency. I would say that I would not concentrate, more than what is required as far as risk is concerned. But I think the spreads which are available between GSEC and corporate bond is something which investors should be mindful of, because these spreads have a tendency to mean revert, and at this point of time the spread between AAA corporate bond and GSEC is the lowest I have seen over long period of time. So I would say that these spreads going ahead would mean revert, and effectively you would get a better spread on AAA corporate bond while you invest at a future point of time compared to what it is right now.
One final question, Mr. Banthia. What are some of the most common mistakes that retail investors make when investing in debt mutual funds, and which you would advise them to guard against?
So I think it's not about only debt mutual funds. I think across asset categories, the common mistake which investors make is that is about human psychology. Whenever something has done well, normally people think that this trend is going to continue forever, and therefore they become very comfortable only after an asset classes delivered returns. Whereas if an asset class is done badly, the assessment of that asset class becomes very negative in investors' mind. I think one should look at a futuristic assessment rather than the past assessment to make a judgment, and I think that's very important. I remember back in 2017-18, people, at that point of time only concentrated on returns, and nobody was, looking at credit risk at that point of time. And that behavior has suddenly changed. In 2020, most of the investors only wanted to move to AAA portfolios, and they thought that the other parts of the credit curve were very, very risky. But the price at which you enter and the price at which you exit is very important. So in 2017-18, the spreads between AAA and the other assets were very narrow. But in 2020, those spreads were at record high. So people entered at a narrow spread and people moved out at a very high spread. So effectively, these kinds of decisions are something which retail investors should avoid. And it's not only in debt, even in equity, if you look at it, people become very comfortable in the market where market has done well over the last 6 months or a year's time. But when markets are to that extent cheap, when prices have corrected a lot, there's a pessimism which sets in, and therefore people become scared to invest. So this is something which I think is very important, but it's not easy. I have seen markets over long periods of time, and investor psychology flows the way it flows, and which is the way the markets have been for a long period of time.
So look ahead. Don't necessarily look back. Looking ahead will help you construct a better portfolio, make better investment decisions. Thank you, Mr. Banthia. It has been a pleasure speaking to you. I have learned a lot. I'm sure our viewers will also learn a lot from watching this interaction. Thank you and have a good day.
Thank you.
Goodbye.